Imagine a government running out of money. Not metaphorically, literally. Teachers unpaid, hospitals waiting, soldiers standing by. And then, without raising taxes, without asking voters, without borrowing from the public, money appears. Quietly, legally, overnight. This is not a conspiracy. It's how the modern financial world actually works. And it rests on an unspoken deal between governments and central banks. A deal that almost nobody votes on, but everybody lives with. Pause for a second and ask yourself a simple question. Who really controls money? Most people say the government. Some say the central bank. Others say markets. The uncomfortable truth is, it only works because all three pretend not to notice how dependent they are on each other. And right now, that deal is being tested. Let's rewind. Governments need money to function. Roads, pensions, defense, welfare, interest on old debt. The bill never stops. But voters hate taxes. Raising them loses elections. So governments borrow instead. They issue bonds, IOUs. Lend us money today, we'll pay you back later with interest. Pension funds buy them. Banks buy them. Insurance companies buy them. For decades, this worked beautifully. Until the math started to break. As populations aged, healthcare costs exploded, economic growth slowed, debt piles got bigger, interest payments grew heavier. And eventually, governments faced an awkward problem. What happens when borrowing itself becomes too expensive? This is where the central bank enters the story. Officially, central banks are independent. They don't take orders from politicians. They don't fund government spending. They only maintain price stability and support employment. That's the public story. The private reality is more delicate. Because when a government can't borrow cheaply anymore, the entire system shakes. Bond yields rise. Debt servicing costs explode. Budgets crack. And suddenly, a finance minister makes a quiet phone call. Not asking for permission, just expecting cooperation. Here's the deal. The government promises to behave, at least on paper. The central bank promises to step in if things get ugly. Not openly, not permanently, just enough to keep the system standing. This is not written in law. It's written in necessity. Let's simplify how this actually works. The government issues bonds. The market sets the interest rate. If investors get nervous, they demand higher returns. That makes borrowing more expensive. At some point, those rates threaten the government's ability to function. That's the red line. When that line is crossed, the central bank steps into the bond market and starts buying government debt. Not directly from the government, from banks and investors. On paper, this preserves independence. In reality, it does one powerful thing. It pushes bond prices up and interest rates down. Suddenly, borrowing becomes affordable again. Crisis avoided. No emergency vote, no televised announcement. Just a balance sheet quietly expanding. This is called quantitative easing. But the name hides the reality. It is money creation with a purpose, and the purpose is stability, or at least the appearance of it. Here's the uncomfortable math. When central banks buy government debt, they are effectively funding deficits with newly created money. Not instantly, not recklessly, but steadily. And once you start, stopping becomes difficult. Because markets adapt. Investors begin to assume support will always be there. Risk feels smaller. Borrowing feels safer. Governments notice this too, and discipline weakens. Why cut spending today when borrowing is cheap? Why anger voters now when central banks are handling it? This is the irony. The tool designed for emergencies becomes permanent. After 2008, central bank balance sheets exploded. After 2020, they went vertical. Trillions created in years, and yet inflation stayed quiet for a while. That convinced many people the old rules no longer applied. Money printing without consequences, debt without limits. But inflation doesn't arrive politely. It waits, then it rushes. When prices finally surged, central banks faced a dilemma: raise interest rates and fight inflation, or protect governments drowning in debt. You can't do both easily. Higher rates mean higher debt costs for governments, for households, for businesses. This is where the unspoken deal starts to crack. Because central banks claim independence, but their actions affect political survival. Raise rates too aggressively and governments fall. Currencies crash, markets revolt. Hold rates too low and inflation erodes trust. Either way, someone pays, and it's rarely the people making the decisions. Let's talk about the quiet humor in all of this. Central banks insist they don't finance governments. Governments insist they don't pressure central banks. Meanwhile, both watch the same bond market nervously. Both react to the same panic signals. Both know what must be done. It's like two people pretending not to coordinate while walking in perfect sync. The danger isn't corruption, it's dependency. Once markets believe central banks will always step in, risk-taking increases, debt grows faster, corrections get postponed, until the system becomes too large to gently manage. This doesn't mean collapse is inevitable, but it does mean choices are narrowing. Every intervention buys time, and time is never free. The real cost shows up later, in inflation, in inequality, in currency weakness. The deal works until confidence breaks, because money, at its core, is belief. Belief that tomorrow will look roughly like today. Belief that numbers on a screen can buy real things. Belief that institutions know what they're doing. When that belief fades, no central bank balance sheet is big enough. So, here's the unresolved question. Can a system built on quiet cooperation survive loud reality? Or will the unspoken deal eventually be spoken during a crisis where there are no easy exits left? That answer isn't written yet. But every bond auction, every rate decision, every temporary emergency measure is part of the same story. And we're still inside it.